Welcome to the Friday edition of The Call. Great to be here with you as we cover 10 stocks in detail, picked by you with my two expert guests over the course of an hour on this, the 24th of September. I'm Nadine Blaney, and special welcome to those of you joining us on Twitter and YouTube, where we're live streaming as well. And by the way, we do the show every day, if you're new to it, Monday through Friday. And you can catch up via our website, or you can listen to it in podcast form as well. I know a lot of people, particularly in Sydney and Melbourne, have been doing a lot of walks around the block lately, myself included. Let's get on with it on this Friday. Always fun with this duo. Jun Bei Liu is joining us from Tribeca Investment Partners. Adam Dawes from Shawn Partners. Guys, it's really good to see you on this Friday afternoon. How's your week been, Adam?
Oh, it's been really good, but really busy as well. Like lots of corporate stuff going through, markets having a little bit of a wobble. It's just providing lots of activity, lots of volatility, which is sort of potentially unnerving a little bit of investors at the moment. But look, it's been a really good week, and I'm glad it's Friday.
Yeah, well, me too. Jun Bei, when we spoke with you earlier in the week after that market wobble, Adam referenced you were excited because, of course, there were opportunities. Did things play out as you had been expecting?
It's always play out much faster than I expected. So I think the day we're talking about buying the dip, and the share price rallied away ever since then. So you know me, whenever the share price fall because of worry about certain things, and it's always a great opportunity to find good company. So yeah, no, it's always a good week.
Good. All right. Well, I know we're looking forward to the weekend, but let's get through this program, which I've been hanging out for. I chose Aventus as the stock of the day, guys. So I'll just run you through a little bit of the news out from the company today. It's put out a trading update saying that cash collection across its portfolio has exceeded forecasts that it provided just back in August. So we're talking the 18th of August. Things have improved since then, which is interesting because it's a retail landlord. It says that trading has about 81% of stores open, 31% of that click and collect. Looking ahead, it says that conditions will remain favorable across retail. And though it's still unable to provide guidance currently, it is talking about confidence inspired by the COVID-19 roadmap, allowing it to provide an improved dividend. So it's made the decision to increase dividends at this time. Look, I'll begin with you, Jun Bei, because all of that sounded really positive from a company that has many of its centers in lockdowns. It's pretty incredible.
Yeah, absolutely. Look, I must say that this company actually has managed the lockdown pretty well because of the location of its centers and, less CBD centric and the like. And the rent collection is looking very strong. Now, this is a sort of consistent feedback also out of some of the bigger malls as well. It's just that, of course, right now the traffic is well down. So look, this company has managed very well, as its share price has indicated. Asset value continue to go higher because of the cheap interest rates and the like. Generally, listed property trust, they get the revaluation of its asset because based on what the prevailing interest rate might be. And so because the interest rates being so low, the asset value just keeps growing. So asset owner is really, having a great time during this sort of environment. And this company's earning has been reasonably defensive throughout that whole period. I think the key thing is that, look, relative to this one, I'd much rather to be buying the likes of the Center Group and the like, because these are the ones that are trading at much bigger discount to its asset value, and most of its portfolio has been impacted by the lockdown and the pandemic. And in the next 12 months, those businesses will have much better, much sharper recovery in earnings and exposed to similar sort of dynamic, but the earnings recovery will be much sharper, and it's a lot cheaper compared to the asset value relative to this one. So this one is probably more of a hold for me, much rather than being the Center Group. And this one also recently had a lot of insider selling as well, so kind of probably will take a little bit more time to wash through.
Got it. So Adam, it's not that it's a bad business in Jun Bei's view, it's just it's already priced in some of that recovery story. Is that how you see Aventus? I mean, do the dividends attract you?
Look, certainly, if you take the backdrop of higher inflation and numbers starting to move, with inflation, you do want to be close to some property stocks or property market stocks due to the fact that they can continue to raise their prices as inflation starts to come through. Obviously, inflation has been a bit of an issue, and now obviously that's taken a little bit more of a back all the tapering and the quantitative easing that's going on at the moment. But yeah, look, it's something that I'm sort of agreeing with Jun Bei. I think that it is right to be looking at the larger ones because the larger ones, Centre Group and well, there's Stockland even, they haven't really run as hard as these ones have. So I'd be cautious of the regional centres. Remember also the regional centres are the ones that only have like a Coles or a Woolworths, which is their main tenant. And then they've got lots of specialty stores that sit around that. So I'd be a little bit cautious as to, those main tenants don't pay a huge amount of rent because they're the anchor tenant. So they're about sort of 4% rent, but then the specialty stores are about 12%, on their sort of takings or rent per month. So you need to make sure that those ones are solid, which obviously Coles, Woolworths and Aldi have been certainly very, very solid. And look, the share price certainly looks like it's moving in the right direction. But I agree with Jun Bei. I want the big ones, and I want the ones that are in the city centres that haven't really seen that take up, haven't really seen that foot traffic coming through. And we know that potentially, fingers crossed, that this all comes through and Christmas is going to be a good trading period for a lot of retail stores.
Yeah, well, I must point out that Aventus has a lot of exposure to, companies that service the home. A lot of those the Good Guys and JB Hi-Fi and Adair's and all that kind of stuff, which of course we've been spending big on our homes as well. But Aventus Group is not a buy from either one of my guests. So that's stock of the day, not going in the portfolio. Let's move on to the questions that have been posed by our viewers. And this one is good one coming from Lynn. It's Woolworths saying, what about this buyback offer? What do your experts think about participating in that? So it's an off-market buyback, Adam. Shareholders are being invited to sell at a discount or at the buyback price. Yep. What advice are you giving clients in terms of participation?
Giving advice every day on this one, and certainly for retail ones. The Commonwealth Bank, the Woolworths, and obviously Transurban came out with the retail entitlement offer just 2 days ago or so as well. So basically, first of all, you need to seek professional advice because we're not tax advisors. So that's the first thing you need to seek professional advice before you do anything within the buyback. The second part of the buyback is that generally it's a way or an effective mechanism for companies to return franking credits back to shareholders. Okay, so that's a big thing for you as a shareholder to get more access to those franking credits. The third thing is though that generally a buyback is only good or only beneficial for clients that have a 0 or a 15% tax rate. Okay, now that could be pensioners, that could be a lot of people, but that obviously excludes a lot of other people as well. So you need to be in that sort of tax bracket for the buyback to make sense. The capital component or the buyback capital component is $4.31 for Woolworths. Now that's fantastic because the share price, let's say the share price is at $39 or $40 at the moment. That means you're selling your shares at a discount or the capital component of $4.31. So that's absolutely fantastic. And then the rest of that is a fully franked dividend. So again, you need to seek professional advice before you go ahead and do this, okay? Now, the third thing is that they obviously ask for a discount and you need to put a discount into when you put your form in. But I always pick the full discount and at the full price. So basically, you're going to take whatever they're going to give you. And then generally, like the Commonwealth Bank one, it's a $6 billion buyback, off-market buyback, but that's only around about 3% of their capital. So there is going to be huge scale backs on these things. So you need to be mindful of how much you're actually putting into this because there will be those huge scale backs going forward as well. So to wrap all that up, Nadine, is that it is beneficial for clients with a lower tax rate and it is beneficial for you to put some of them in, but don't expect to get your full allocation on the buyback. You will get scale back and there will be, say, Commonwealth Bank, I think is a minimum 100 shares, which is about 10 grand. So I think Woolworths will be somewhat the same. So it is a good tax strategy for clients, but generally only use it for clients that are overweight a certain stock. So something like Commonwealth Bank, they're overweight, and then hence I'm happy to reduce into that buyback for them. Same with Woolworths, a lot of clients are overweight. So I don't know if that answers the question, but I think I've gotten halfway there.
Well, it's a lot of information, so thank you for that. Jun Bei, the other side of that coin is that if you don't participate in the buyback, then in essence, it's a very simplistic way of looking at it, but your Woolworths shares become more valuable, of course, because there are fewer on offer, correct?
Theoretically. And now I think Adam's been fantastic in covering off, all of that, in terms of retail tax positions and where you might land. And I'm certainly telling my mother to buy to surrender into it, because she has a very low tax rate.
Yeah.
Now you're absolutely right. Putting this buyback aside, looking at the business on itself, right? So if you don't participate, that means you think the share price is going higher. Now Woolworth has been the huge beneficiary, has done very well throughout the pandemic in the last year and a half. As a retail investor, share price probably is not going any higher, because the thing's just been so good for this business. When the world does return to normal, people will spend perhaps a little bit less through the supermarkets. And also at the moment, there's also a bit of pressure coming through supply chain of having stock available for Christmas. I think Woolworth themselves have said that potentially maple syrup will be gone by Christmas. So there's a bit of cost pressure. There's a bit of stock shortages. So look, the earnings will be fine, but you're probably looking at flattish earnings for the next couple of years, and you're paying a big price for it. It's probably the most expensive staple at this point. For me, Woolworth is it's probably a sell. I would put into things like Endeavour, or even Coles has really, been hurt by the latest lockdown. So, it just make your money work for you.
Yeah, okay. And I will revisit you on that, because if you've got a lot of people asking you about the share buyback, that means you've got a lot of your clients invested in Woolies. Are you advising them to hold overall or to lighten as a general rule of thumb?
I absolutely will be. Oh, sorry,
Yeah.
Adam, you go.
Yep, go Adam.
Yeah, sorry. Yeah. Well, basically, I've got a buy on Woolworths, and I'm quite comfortable. I said to a client the other day, I always like bread, milk, and cheese kind of stocks because no matter what the economy's doing, it is basically going to do well. He said, "Well, I'm dairy and gluten free, so that doesn't relate to me."
I tell you, Adam, what do you tell your clients to put in? You put in the alcohol, which is the Endeavour. That one's much cheaper, a lot more growth rate, and then there's a lot more, reopening thematic.
Ding, 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 ding. I think it's a Friday around here because, everybody's got a bit of wine on the mind today. So you're a buy for Woolworths. Jun Bei is a sell. I like that you guys can disagree. That makes a market. And Jun Bei, I had no idea that we are looking at a maple syrup shortage by Christmas. I'm going to stock
buy
that.
it now.
Yes.
But I think after this show, you may well be shortage tomorrow.
Oh no, I can't handle the imitators for obvious reasons.
Yeah.
Okay.
Oh, can't you?
Yeah, but it gets stuck in a quarantine. All right, let's go on to the next company on our list. It is Boss Resources for Callum, BOE. Jun Bei, last week we were talking about uranium that was swiftly replaced by Evergrande this week. Still though, plenty of interest in uranium companies. Jun Bei, you can either talk to the thematic or talk to Boss Resources in particular. It has this Honeymoon uranium project in South Australia. If you're interested in uranium, is this a good way to gain exposure?
Yeah, look, we actually have a uranium fund in our company, and this is actually their top pick. So we were actually substantial in this company and recently just ceased, really just taking some profit because it's done so well. According to our team, that this one has all the project ready to go, has all the approvals, have everything ready to go. So to me, it's much high quality compared to the rest of them. So it is probably the one that you want to buy to gain exposure to uranium. But now, taking a step back in terms of overall uranium sector, I think there's good demand coming through for that. But do be mindful that the sector has gone through tremendous return in the last month or so. There can be a little bit of heat coming through, especially if the world is going to worry a little bit about growth and things. So, but this is the one is the one to buy if you want to gain exposure to uranium.
Yes, and noted that perhaps it would be better to do on a pullback. I know that you guys there at Shaw Partners are favorable on uranium. Is Boss the pick of the bunch?
Look, we've got two, Paladin and Boss. So I'm going to stick with our Shaw and Partners research and say that yes, Boss is a buy for us here at Shaw's. One of the things that you've got to look at is obviously the spot commodity price. And what happens is with anything, whether it's coal, iron ore, anything like that, the spot price will determine where the share price is going to go. So obviously we've seen iron ore come from $240 down to $100 or below $100 this week and then smartly come back up. And we've seen BHP's share price, Fortescue's share price and Rio's share price follow that iron ore price down. Now what's happening at the moment in the uranium market, and uranium's had about 20 million false starts over the last 10 to 15 years. Everybody said that uranium market's the place to be, and it's been a bit of a false start. But what's happened that's different this time, what's happened is that there's a Canadian group called Sprott Asset Management. Now, Sprott are going in and buying physical uranium in the market. They've got a very large gold fund called Sprott Asset Management Gold Fund, and they use gold as a store of value. Now, what they're doing with uranium is exactly the same thing. They're going in and buying physical uranium in the market, which has then moved the spot price of uranium to sort of all-time highs over the last 10 to 15 years. But what has happened now, we've seen a little bit of a pullback in the uranium spot price. But what Sprott Asset Management has said is that they've now put over just $1 billion into the uranium market, and they've got another $1 billion to reload to come back in again. So that makes me feel very, very confident that this uranium market will continue to do well because of this Sprott Asset Management buying that's going in behind that. So we've got a buy on Paladin and a buy on BOE.
Jun Bei, are you comfortable with us putting that one in the portfolio?
I think the BOE I'm a little bit more comfortable, and the Paladin, look, I still have to look into it. I agree with Adam. That's been so many years, and Paladin was one of the first that we heard about the uranium, probably more than a decade ago. So yeah, I'll stick with the Boss.
But you're comfortable putting Boss in. That's what I was checking in on. Yeah.
Oh, absolutely.
Okay, great. That is going in the portfolio. All right, we are on the ball here today. Let's get to Lynch Group, LGL for Frank. I had to look this one up, and I thought it was pretty interesting. It only listed in April 2021, so granted, not a lot of history there, but it's been around for a long time. This is Australia's biggest seller of cut flowers, but it does so into the Australian market and the Chinese market. I'm sure I'm not telling you guys anything you don't know. So it has been hit through COVID, obviously, also being hit by supply chain disruptions, but it's thinking about expanding its operations in China. And I don't know about you, Jun Bei, but I love having fresh flowers in the house. What do you make of this company, Lynch Group?
Yeah, look, it's all sound very interesting. I like it, but look, let's talk through the other things. The main reason I like it is because the growth angle for this company, being the one of the largest distributor in Australia, is that they have this growth angle into China. That's when they listed, they raised money to buy out the other partner, and they essentially trying to gain exposure and sell flowers sourced from China and sell it to Chinese household as the household getting richer. I always love that angle, and they're doing quite well there. And this is where I feel where the upside is coming from. Now, the big part of the business, of course, is Australia, which is a very mature business. And I think in a way they did get disrupted by the pandemic. However, they because of pandemic, Australia actually import a lot of its flowers, which I didn't realize before I learned about it. So it actually cut out a lot of competition. So during the pandemic period, and obviously people can't travel, there was a lot of flower sent. So all these flowers actually, they've been getting very good prices for whoever can get the price through. Now, once we start opening the border, there's a possibility for more competition to come in, as it was with a few years ago. So so for the big part of the business, it might be a bit challenging as the world returns to normal. But with China, certainly that's what's attractive. Now, I'm putting this stock on a hold at this point because it is incredibly illiquid, and it's coming out of private equity. Recently, actually had a good result. It beat prospective forecast. Management done a good job. It's just that liquidity has been very tough. I kind of need to see a bit more execution, just given its history, its short history.
Adam, how about you?
Yeah, look, it's one of those ones that is very, very illiquid, and I agree with Jun Bei that it is always a concern when you need to get in and out of these things, and it's just a little bit tight because it really, I think by the time I'd come on the show here, I don't think it had actually maybe even traded one parcel of shares today. So, but it certainly looks interesting because, as Jun Bei said, they definitely beat their guidance. They came in with a guidance range of 31 to 32 mil, which is quite small. So that means they're very confident that they're actually going to get that range or get that guidance. And that was lifted from 29 million from the prospectus forecast. So that's pretty good as well. They have a dominant position in that flower growing space. And, my wife loves fresh flowers in the house as well. So, I always get a tick when I bring home a bunch of flowers. But look, besides that, I don't buy the supermarket ones. So, the supermarket ones are a little bit sort of dodgy. Is that fair to say? But no.
Throwing shade on supermarket flowers, I see. I hope your
love
wife.
the supermarket flowers.
I get Aldi flowers sometimes.
Listen, it's like petrol station flowers. Like, they're not that great, are they? Let's be honest. Anyway. I'm digressing, but look, I think revenue looks good. They've upgraded EBITDA. They've got a net profit. My only real concern is that illiquid or that it can't trade a lot. So I think this one is a hold for me as well. If we see a bump in the road and this share price gets whacked, then absolutely this is a time to be buying this one. But up here it looks a little bit lofty and a little bit tough to manage for clients. So I'd stay clear just at the moment.
Mrs. Dawes is expecting a really beautiful bunch of flowers now when you return home from the city. All right, let's get on to APA. This one is from Shahana, and she's given us a bit of color. Obviously, she sees that there's potentially an attractive dividend yield on offer. She thinks potentially a share price upside. Is it time to buy this reliable dividend player? Keeping in mind as well, it's got a takeover bid for AusNet on the table. She's wondering if it will boost the share price. I must say though, guys, we've seen a bit of weakness in the APA share price after it made that bid for AusNet Services. Jun Bei, I'll start with you on this one. Do you like the story of APA transforming itself into an infrastructure business from a pure pipeline business?
I'm just a little bit confused. It sounds like they're trying to turn themselves into a ultra defensive business with a very little growth. Look, it's confusing to investor because APA has always talked to potential growth in the US and things, and all of a sudden they started bidding, trying to outbid Brookfield and to try to get a domestic infrastructure business. So it does seem a little bit confusing in terms of where they're going in terms of strategy. My view of APA is that it is just not it doesn't grow its earnings. It's really just a dividend business. It's extremely passive. I'm actually not sure about the synergies once they do take over AST. Its dividend is pretty high in the current market, given the interest rate is very low. Now, the problem with those companies, you have to be careful, is that because the earnings is not growing, maybe they're just getting desperate. They have to buy something because earnings not growing. And if the interest rate ever in the future goes up, it will see its earning going backwards because these are regulated utilities, and it's difficult for them to pass on 100% of the rise in interest rate. So their margin just get crunched. So which means the share price will go down. Now we're almost at the verge of seeing some of the interest rates started moving higher a little bit in the longer end, so say in 2-3 years time, this company will absolutely be impacted. So so I can't get very excited about this business. Only way out for this business is for mergers and acquisitions. Someone come in, either a super fund or something, take it private, possible, but can't invest based on potentially who might get taken out.
So that is an avoid for Jun Bei. Adam, does APA have some defensive qualities that are worthwhile in a portfolio?
Yeah, look, absolutely. It's been the last 3-4 months hasn't been a star performer, but certainly APA has always had that defensive characteristic about it because it is basically infrastructure, and they clip the ticket from the gas pipeline in Moomba all the way through to the ship in Brisbane, and the ship then takes it off over around the world. So it's a fantastic business. Just clip the amount of gas that's going through the pipeline. However, what I take a step back and say that, you know, it is interesting to look at this business because there's a lot of companies out there, you know, Canadian Pension Fund, all of these big guys that are looking for infrastructure stocks. So you've got Sydney airports getting taken over, you know, you've got Spark Infrastructure getting taken over. These guys are looking for good quality infrastructure assets. So this firmly, to Jun Bei's point, firmly sits in that sort of, this could be a takeover target. Okay, so, you know, you look at that and you think, okay, well, that's great. You know, maybe I'll look to buy some because of its depressed price from $11 down to $8.74 where it is today. However, I think this has been also hit with a bit of an ESG kind of angle, that people aren't wanting to get access or don't like pollutants or oil and gas and those kinds of things. And they're sort of putting that into that ESG bucket, and hence it getting sold down irregularly as well. So there's a couple of things that are going for it, but there's also a couple of things that aren't working for it as well. I think they're trying to make this acquisition because they can see that they need to then diversify earnings, and they need to diversify that out. And how they're going to do that, they're looking at AST as a way to do that. But for me, I think it's a definite hold. I've got a lot of clients in this, and I just don't know what to do at the moment. It is looking shaky, but it has got such great assets that I'm potentially hoping for a takeover. So yeah, I'd say hold. I really think it's a great business. They run it very, very well, pays a good dividend, but it's just in the wrong space at the moment. So it needs to shake off some of those bad vibes.
So it is not a buy, and that is APA Group for Shahana. Look, we've got one more on the list before you guys can have a bit of a breather. It's Magellan from Sabir saying, look, is it a stock you buy for the long term, like Warren Buffett says, be greedy when others are fearful because the share price has been hit hard? Adam, Magellan.
Look, this one has been hit really hard, and really it's got a lot to do with not the fund, because the fund has doing okay, albeit he's had a lot of cash and he's been very vocal about holding a lot of cash. And look, if this market does take a bit of a sideways move or a downward move, these guys will outperform because of their cash holdings. So that's absolutely sitting in there. But it's really about some of the other acquisitions that Magellan have started to do in the back end. So they're buying Barrenjoey, or have bought or taken a share in Barrenjoey. That's looking like it's going to take another 5 years before it becomes profitable. And that's certainly something that I think is worrying investors. They've also bought the FinClear asset or book, which is basically a settlement. So, you know, they are trying to do a couple of other things with the business. I think down here, it looks good. I like it. I think they know what they're doing. I haven't put a buy on it yet because I haven't seen that it's fallen, but I haven't seen that sideways movement that you like to see in a share price before it starts to go up again. So I might go out on a limb here and say somewhere around here it's a buy, because I think at $54 it was looking very expensive. At 37, I think it looks good, and you can sort of see those previous lows. It's looking good that there should be some support here. So I'm going to go out and say it's a buy, but there's lots of water still needs to go under the bridge on Magellan, and he needs to, being Hamish, needs to, I guess, make markets feel a little bit more comfortable about it, because what we have seen as well is a lot of retail outflows. And it's the first time in many, many years, and Nadine and Jun Bei, you and I have been talking about this stock for a long, long time, and always said, look, they've had so much great inflows, everything's fantastic, but we're now starting to see some outflows coming through. And if that starts to pick up some steam, then this share price could go a little bit lower as well. But I think it's a buy. I like the business. I like what they do. I'm comfortable to pick it up at these levels.
Would you be a buyer of Magellan at these levels if you're a retail investor, Jun Bei?
No. So let me address some of the things that in the email the retail investor has mentioned. That, you know, is Magellan something buy that you can just buy and hold, and, you know, put in the high quality company, put in the bottom drawer? No, I would never hold a fund manager in the bottom drawer. So only asset manager I would hold to put in the bottom drawer is Macquarie Bank. Because it's reach, it's exposure, and it's all these factors that's going for that business that is very different. Whereas the equity fund managers, you have to trade them. So you buy them when they seem to have time, but you need to buy them when their flow start to turn positive. You never want to buy fund manager when the flow turns negative, because when it's negative, it put pressure on the investment team to generate outperformance, and then they actually then people will leave, and then generally creates that sort of negative momentum. And when the performance doesn't turn, and there's more outflows, and we've seen many fund managers, listed fund managers like the Janus, like the Pendle, in previous few years, they all went through very challenging periods. So you want to follow the flow. Whenever they have inflow, you can, buy into them. So at the moment, who's having inflow? Pinnacle is having fantastic inflow, and they give you a fantastic leverage to the upside as well. It's expensive, but it's just got such a great momentum going for it. Magellan's on the other hand is going the other way, and the challenging thing is at the moment the performance is a little bit weak, and they something like 16% behind their benchmark. Now that will take a long time to catch up, so that means the outflow is not going to disappear anytime soon, so your share price will follow that outflow. Pendle potentially have a few things, positive news flow coming through just in terms of flow. So you want to be in the managers that's kind of just turning positive and gathering that positive momentum, and then they give you a good return. But look, fund managers, you've got to trade them. When you make your money, you do want to take some profits.
Thank you, Jun Bei. Thanks, Adam. We're at the halfway mark. I'll just do a quick summary, let you guys catch your breath and think about what's coming next. Now, the first company that we discussed today was the stock of the day, Aventus, and I picked it because it's traveling really well through this pandemic. But Jun Bei says it's a hold. She'd rather be in a center group, for example, that still has the recovery story ahead of it. Adam agrees. He wants to be in the CBD, in those prime properties, as this recovery takes hold. So that's not a buy for Aventus. Woolworths, it is a buy for Adam Dawes. We had a lot of detail there on the share buyback and options available. Just keep in mind that what we do here, it's information only. It's not advice particular to your circumstances, and particularly in this case, you do need to get some tax advice, as Adam detailed. Now, Jun Bei says as a company, she wouldn't be buying Woolworths. It's a hold at best. In fact, I'm wrong. It's a sell for Jun Bei. Why wouldn't you put your money in Endeavour or even Coles? But I think Endeavour, with its exposure, has interested Jun Bei more. Boss Resources is going in the portfolio. It's a buy from both of my guests. It's very high quality. And you do want to get on that uranium train in Adam Dawes' view, and you can do that by Paladin or Boss. Lynch Group in the flowers space. It's a hold for both of my guests. The biggest issue is its illiquidity, but they are watching it with interest, growth in China, and an interesting part of the market considering it beat its prospectus forecasts, which was quite tight as well. APA is a hold for Adam. He does say that it's looking shaky. It's in the wrong space right now, but he just is not ready to ditch it because it does have those defensive qualities. It's pretty well run, and it pays that reliable dividend. But Jun Bei says, no, avoid it, sell it. It's confused. There's very little growth, doesn't show earnings. Not sure of the synergies. If it does get AusNet services, it's not a no-go for her. And you've just heard them talking about Magellan. Magellan is not one you put in the bottom drawer in Jun Bei's view. You need to trade fund managers. You just told her saying it. And you want to wait to get in these guys until funds under management are growing. The only company that she'd put in the bottom drawer in this space is Macquarie. So take that for what it's worth. It's a buy, though. For Adam, he says he wants to see more sideways movement before getting in, but at these levels, he thinks it's cheap. That is what we've been talking about today. Now, you heard me say that Boss is going into this fantasy portfolio that we have going on here, thanks to our partner, NabTrade, any company that gets 2 thumbs up on the day. So a buy today from our guests goes in. And weekly, we're up, well, just smalls. It's been a volatile week over the month, 1.7%, year to date, more than 5%. But since the inception of this portfolio, we're up by 42%. And both of my guests today have put companies in there over the past year and a half. Yesterday, we added Atomos. Recently, we added Core Lithium. We added Zoom to You this week, Drone Shield, and AACo. It's been a big week. We've taken out A2 Milk, New Hope Medical Devices, and Rio Tinto recently. Now you can look at that portfolio. The address is on the bottom of your screen, ausbiz.co/portfolio. So there you go. Let's see if we get any other companies into the Ausbiz portfolio. Evolution Mining is the first on the list. EVN for Corrine. She's an existing shareholder, but she's wondering whether, with all the money printing and all the bad news out there at times, why we're not seeing the gold price rising. Wants to know if Evolution is a company that you like, Adam.
Yeah, well, in a word, yes. I think Evolution is a very good company. One of the things that I think Bitcoin has got a lot to answer for at the moment is that, I think Bitcoin has taken away a lot of that gold trading, or that sort of store of value that we've always seen for gold. And that's really sort of why I think that the gold price, in fact, the spot price, really isn't moving in the right direction. And then I think the second thing is that we've started to see some of the consolidation in the mining space, and it's basically either go big or go home. So you've seen the Northern Star and the Saracen merge together. Newcrest is big enough, but it seems like that Evolution's been left a little bit on the sidelines at the moment. So look, I've always said Evolution, Northern Star, and Newcrest are my sort of top three picks in the gold space. However, I think Northern Star looks a bit cheaper on an evaluation and production model. So I think that it's going to be ranked Newcrest, Northern Star, then Evolution is my sort of third one in that space. But all in all, I think that overall the gold price should do okay. If inflation starts to rise, it's the same story. We might see that gold price start to tick up, which should then help Evolution. But I'll be neutral on Evolution at the moment. I'll have a hold and sit on the sidelines and see how it goes.
Jun Bei, I know that you prefer the big miners in the gold space over any of the smaller players, or the explorers, most certainly. Do you think that Evolution is a happy hold? Would you prefer to be in one of the other big players?
Yeah, look, I think it looks okay. Prefer to probably more in the Northern Star, but I think it looks okay. Newcrest, I'm not a massive fan of. So look, so that's kind of my preference for that space. And I think just to answer to the viewer's question is, with all the money printing, gold should do well. Look, normally gold price does well in two sort of environments. Either when inflation is becoming rampant, out of control, you want to be in gold because, that's kind of inflation hedge. Yeah, that's where gold sits. Or when the world falling apart, everyone's worried about whether there will be tomorrow, gold is a holder of value. So, only at those two extreme times where, gold normally performs very well in these two times. Now, we're somewhere in between at the moment because we have recovered from pandemic. Things were actually looking a little bit better than expected, but we don't have really severe inflation issue yet. So in between periods, we will see some weakness across gold because, everything else that looks more interesting, whether it's cyclicals, it's other businesses. So, gold normally do lose its shine a little bit during the sort of this phase. So so my my sort of exposure to gold is sort of more neutral because I just feel this environment is probably not fantastic for the gold price. But out of the majors, I do like the Northern Star, and Evolution kind of looks okay in that basket too.
Got it. Thank you, Jun Bei. All right, let's get on to the next company on the list, Anteotech. This one is for George. He says they've submitted a rapid antigen COVID test to the TGA for approval, but is it too late? So, yeah, we've talked about this company before, I think with you guys. ADO, yeah. Adam, what do you make of it?
Yeah, it looks good. And all of the things that, they talk about, the company talks about, you sort of think, well, actually it makes sense for what they're trying to do. But I sort of I look back to something like a Nanosonics, and in the early days, Nanosonics was getting some really good traction with all of their photon and the antibacterial microbe probes that they had. But the problem is that they couldn't ramp up production enough if they got a large order. And I think this is exactly where ADO is at the moment, is that they've got existing inventory for this strip that they can use to test COVID. But the problem is that they're not going to be able to ramp up production enough to get it there if there's going to be huge demand for this. So they've said that the Australian or their Brisbane strip manufacturing is to come online early 2022. But again, and they've got some capacity existing manufacturing in Spain. But that means that they can only really do around about 32 million tests, or equal to about 1.2 million kits. But the amount of testing that COVID is doing at the moment, and we see the numbers every day on television, this many people were tested, this many people have got it, this many people have died, all these kinds of things. And then does the vaccine actually negate a lot of this testing needed as well? So I think it's in the right space. I think it's a little bit late, as you said, Nadine. I think it's a little bit late to the party. But I'm just concerned on that ramp up of that production. If they do get some large orders, are they going to be able to fill it? And then, you sort of then have to spend more money to ramp up production. And then, so I'm a little bit cautious on this one. I don't think I would buy it. But if you've got it, I think it's in a good space and it should do well. So it's a hold from me.
Because, Jun Bei, we are likely to be submitted to rapid COVID testing for the foreseeable future in certain scenarios. So there's got to be a way to play it. Is this the way?
Possibly. I think absolutely agree with Adam that, with those businesses, the early stage, there's a lot of risks. Even if they get approval and everything seems ready to go, things go wrong. And contracts always take longer to come through, and, ramp up and distribution costs and initial stage of rolling out and ramp up always have hiccups. And we've seen it again and again with most medtech companies. So my view is that it's in the right place. It feels a little bit late, but I think that there will be sustained requirement for that sort of test. But the question is, you also have to be mindful. There are heaps of other companies who are also rushing to come up with similar sort of technology and things. So competition will pick up as well. So, just feel a little bit late at this point. If I hold it, sorry, I wouldn't be holding it. I couldn't imagine holding it. To me, it's probably avoid at this stage.
Got it. Thank you, Jun Bei. All right, it's lunchtime. I'm getting a bit hungry. The next company on the list is Retail Food Group, RFG, Pizza, Donut King, you know it, Gloria Jean's Coffee. Now, Sean has written in to say, could this be a turnaround story, a reopening story? Once shopping centres are full once again. Also talks about new management looking to really turn things around. First year in a while that it's made a profit as well. Jun Bei, what about RFG?
It's too early. You need to watch it a little bit longer. This company has had a very challenging turnaround. They have so much problems and issues with their franchisees. And as you know, as a master franchisor, you make money from selling products and things to your franchisee. And if you have a terrible track record, it always take a very long time for that reputation to rebuild and to build enough confidence really for your franchisees to expand and things. So far, I think, the new management has certainly demonstrated that they're real about it and they really want to turn this around. But it just, to me, I just feel there are so many other opportunities to invest in that kind of business. Look at Domino's, how much money they made from this whole pandemic, and even throughout the last decade it's been listed and now it's expanding into other markets. You much rather to pay a little bit more to be with the market leader that has, rather than a turnaround story. Turnaround story is always going to be difficult, and they will do well for a couple of years and there'll be something else. It's just hiccup, and it's just a lot of execution risk involved with this one. I'm avoid, much rather to be in the likes of
Domino's, that's a bonus buy coming from Jun Bei. All right. Adam, how about you?
Yeah, so we cover this one, and I'm going to stay with our analyst on this one. Shaw & Partners has a buy on RFG. Ready, everybody? This is high risk. This is high risk, okay? So, don't go out and buy it because, potentially Jun Bei said no and I said yes. But just be careful with this one because it is a very, very high risk and it is a turnaround story. But there is two catalysts that I think will do well for this story, and the first one is obviously reopening of COVID. Absolutely, I think that will do well. We've got a 14 cent price target on it, so it is a little bit above where it is at the moment. But the second thing that I really like is the ACCC, and it is in court at the moment. Now, one of my first rules of investing is never get invested with a business that has legal proceedings against it, due to the fact that it takes their eye off the ball from running the business. Plus, it drains extra costs with lots of lawyers and every else trying to get in on there. So it definitely drags the business down. So once that ACCC announcement has come out, and if it is positive for RFG, that is a huge stumbling block that these guys will get over, and we can start to move forward. And I think that's one of the biggest things that's holding it back. ACCC was supposed to announce it about a couple of weeks ago, but they delayed it, and now they're coming out. So I think it's definitely going to come out before Christmas. So that would be my first catalyst. The ACCC says tick. The second thing is that the management is very, very, very good. They have done very well to turn this business around. It is still struggling and is still very, very high risk, but I do think that management have it in the right place to go forward. So there's a couple of things there, but be very careful, people. Don't buy this one just on the back of me saying, yes, I like it.
Sean, you heard that. Take it on board and do your own research. Let's get to Bapcor, BAP. Citi, just yesterday, sent a rocket under its share price, saying that the risk-reward trade-off has become favorable now that the share price has declined. It has a buy on the company. Also, again, this theme, this reopening theme, continually coming up. Jun Bei, you've referenced sort of the new normal post-COVID. Is Bapcor, in your view, one of those companies that you can have in your portfolio to benefit from that reopening trade?
Yeah, Bapcor confused me a little bit about the reopening thing. So because they have done very well leading up, during the whole pandemic period, kind of initially when we had the lockdown last year, if you remember, and very quickly, a lot of major cities opened, and then the roads were busy. There were a lot of people driving on the roads, and so the car yards have been busy. So things actually have been going very well for the likes of this one, and even the super retail. It's car components as well. So that's actually been doing really well up until recently. We had another lockdown, and obviously earnings have been impacted. So in a reopened environment, yes, the car yards will start doing a little bit better. But honestly, I just feel the net exposure, once we can start flying, maybe we won't drive as much. Maybe we'll travel interstate instead. But look, it is cheap. It has been punished on the poor result. I think, you'll make your mid-single-digit return out of this one. It's a hold for me. I'm not super excited, but I think it will make some return. But, for a reopening trade, there are so many others you can make a lot more from.
Got it. Thank you. Adam, how about you? Bapcor, what's the house view at Shaw & Partners? Are you going to tow it or go your own way?
No, I'm going to go my own way on this one. We don't cover it, so I'll go my own way on this one. But look, it's very conservative. The consensus is very conservative for what they've got, and I'm reading Citi's research as well, where they did say that they're sort of upgrading their forecasts and the compound annual growth rate of around about sort of 7.5%. So it actually doesn't look too bad. The first thing is, this is a rollout story. So in other words, they need to roll out more stores to get to more people and those kinds of things. And they're sort of doing that, but they've been obviously held back by the COVID side of things. But if borders do open over the next coming couple of weeks/months, fingers crossed, then a lot of people will be driving, and that obviously works well for them. On the negative side is that, new car sales continue to rise, and there's a lot of demand, but also in the used car space, there's lots of demand as well. But obviously, if a person buys a new car, you don't really need to get lots of parts. You don't really need to get anything because you've got a new car and it's sort of there for sort of 3 or 4 years. So you'd like to see new car sales slow a little bit. That would help Bapcor's retail business going forward as well. So borders opening, I'm with Jun Bei. I'm a hold. I've never really gotten involved in this story or looked at it. I'm not a car person myself, so I'd say a hold, but it does look cheap on a metrics valuation.
Thank you, Bapcor, for Jen. Let's move on to this final company on the list for Jim. It's Enero Group, EGG, and I clearly remember hosting this program with you guys when we could be in studio together, and Enero coming up, and both of you, just going by memory, thought, aha, it's actually interesting. it's an interesting company. So Jun Bei, have you done your research since then? Have you formed a view on Enero? Would you be buying it today?
I looked at it again. I was thinking, gosh, that looks familiar. And then I go, that looks interesting. I will do more research. Share price seems like doing okay. And look, it absolutely looks interesting. And no more homework required. I think I stand by what I said last time.
All right. So we are keeping Enero on the watch list. Adam, how about you? Creative content, integrated communications, PR, but they've got some big brands on their books, and yet their revenue seems to be doing quite well, at least.
Yeah, it's probably one of the few ASX listed small caps that looks sort of quite cheap on an earnings growth outlook, despite sort of the share price strength over the last coming while. Look, it's an interesting because it is quite global. They're all around the world with this one, and I obviously continue to see some earnings upside with this one, and sort of a strong tech pipeline, which gives opportunities for them to look at some more mergers and acquisitions going forward. Yeah, for me, I don't get too excited about communications and IR and those kinds of businesses. I suspect they make some good money, but it's just something that I really don't get involved in. So I'm going to say and avoid because I don't really understand the business.
And it is important to be able to... Yep, Jun Bei, go ahead.
Can I just jump in? Now, it's all coming back to me now. So this is the old Photon Group. That's it. Yes. I absolutely love marketing and communication businesses, and then they're very key person centric. So, previously the problem was that a lot of key managers left, and then they lost all the talent and they lost the account. Now, one thing I can say about this one is absolutely warrant more work. And two is that at the moment, every company we have heard from during this reporting season have talked to increasing marketing spends, increasing, brand imaging sort of, or technology marketing systems sort of spend. So we are seeing a lot of money being throwing at the marketing and communication front. So honestly, I think at the moment, the macro environment is pretty good for this business. Usually they do well when there's a lot of demand, their margin expand and things, and there's a lot more activity to go around. But obviously have to do work into this, but the environment seems to be pretty good for this company.
Yeah, interesting that it is a cyclical business as well. Thank you for all of that. Jun Bei Liu from Tribeca Investment Partners, Adam Dawes from Shaw & Partners. Look, I can't wait till we can sit in the studio together, but in the meantime, it's great to have you guys joining us virtually. Adam, you've got to go get those flowers for your wife on the way home. Just say that, put that out there. And Jun Bei, I do hope you have a really good weekend, and we look forward to speaking with you both soon.
Thank you so much. Thank you.
Thanks, Dave.
Okay, I'll just quickly wrap it up for you. I won't go into too much detail. But if we're talking about the last company, or first on the list, Evolution Mining, they both like it. They're not passionate about it. It's a hold for both. Adam has ranked his gold miners, Newcrest, Northern Star, followed by Evolution. Northern Star is top of the list for Jun Bei, but she says, look, it's just not a really exciting time to be in gold. So that might explain the gold price question that was posed as well. Anteotech, it's an avoid for Jun Bei. It's risky. These things might have a lot of potential, but there's a lot that can go wrong as they look to execute and get to commercialization and production. And that's the issue for Adam as well. It's a hold for him. Retail Food Group is a buy high risk for Adam Dawes from Shaw & Partners. Shaw & Partners has a buy on the stock. He does see that there are catalysts in its future, but it is high risk. June says any turnaround is very challenging. This one in particular, she's avoiding it, but she would look more favorably on a Domino's pizza as a bit of a bonus. Bapcor, it's a hold for both of our guests. Enero Group was last on the list. It's an avoid for Adam. He doesn't understand these businesses, but it's looking pretty interesting to Jun Bei, who's going to be doing a bit more work on that one. EGG was the ticker code there. Listen, that brings us to the end of the program for today. Of course, we'll do this all over again on Monday, where Koshi is back, and he's going to be doing a bit of a stock series for Stock of the Day. So companies that you'd want to hold to help fund Well, it could be education costs for your children, for your grandchildren. So we'll get a bit of a stock of the day theme going for the long term. That starts Monday. If you have a question, you can email us at the call, ausbiz.com.au, or we're always on Twitter at ausbiztv, and you can check out that fantasy portfolio at ausbiz.co/portfolio.